Hey traders, Raghee here, and in this update we're going to take a look at the two-day rally. We've had two very strong days of market action, and while there's a lot to be said about whether or not the market's rallying because of gridlock, the gridlock rally, whether the market's rallying because the concern of the uncertainty of change, in this case going from, say, a Republican administration to a Democratic, the blue wave, all these political, psychological reasons. This isn't about politics. This is about the psychology that the politics trigger. One thing that's been really underestimated, and it's a very steady guideline that we adhere to in the futures room, and that is don't short in front of Jerome Powell, or as we endearingly call him, Ka-Powell. You don't want to be short in front of a Ka-Powell moment. Now, after, that's a completely different conversation. But you don't want to short these events. And today is an FOMC day. Easy to lose sight of that when we have all the nonstop, wall-to-wall election coverage, ballot counting, all these very tight contests, and now the different lawsuits that seem to be happening. And yet, today, we have a Thursday FOMC meeting. And usually going into the meeting, you can call it the session before and the session of, the market will tend to rally in front of this. Because let's remember, and I think there's a really interesting infographic that I ran across, and let me bring it up here, just to kind of quell everybody's concerns about, oh, is the market going to sell off or not? Now, this is not my data. This is from Dow Jones indices and Hulbert rate. I don't know who. I found this online. It jives with what I've anecdotally experienced throughout my 3 decades of the market. And we are heading towards one of the scenarios that is typically going to be a bullish scenario. In fact, one of the top bullish scenarios, because you'll see here, the only other scenario that's better than the current one that we're probably venturing into is a unified government that's all Republican. This is not Democratic, gang. These are probabilities. This is history, right? And then the history dictates sort of the psychological expectations we now have. All right, so if that's what the market is now factoring in, great. Let's stick to the long side. And one of the things that I mentioned to my traders in our nightly premium video is, as of the recent rallies, we are now trading above the rolling 10-day anchored volume-weighted average price, as well as the anchored November 1 volume-weighted average price. And as of yesterday, we broke October 1st's volume-weighted average price. And this isn't just in the S&P and the NASDAQ, which we played to the long side today, because the directional bias is bullish. This is happening across all the major averages. So this is going to put us back in bullish directional bias after a very brief amount of time, less than, let's see, 1, 2, 3, 4, 5, less than 7 sessions of some bearish directional bias. We've gone right back to bullish using the volume weighted average prices to find the path of least resistance, which right now is up. All right, so that's what we're doing here this morning. That's the reason why. And again, don't get too caught up in the election. There's a probability that I believe is already in play. Gridlock completed that probability with the expectation of a Biden victory, but a split Congress. And this is just probabilities, gang. The market just wants this done with. It knows what it's likely going to see because history's told us. And the sooner we can get past the election, the sooner the market can go back to rallying on hopes of stimulus. And I'm only slightly kidding. So let's keep our bias to the upside as long as the technicals and the probabilities tell us to do so. And I'll see you in the next update.